Hello, everyone, and thanks for tuning in to Financial Conversations with KMAC. We are here today with the president and founder of KMAC Financial Solutions LLC, Mr. Kenjamin McDougal. Thank you for being here. And for those who are not aware of you or your business, go ahead and give us a brief intro about who you are and the purpose behind KMAC Financial Solutions.
Kenjamin McDougal, as you stated earlier. I've been in management for about 24 years. I've worked in both blue collar and white collar. I've also worked in a few government sectors. KMAC Financial Solution is a business that I prayed about prior to starting back in, I believe, 2016, where I can help provide my community that I've been a part of, just people in general, a better way to grow generational wealth, to understand generational wealth, to understand what that looks like for them and how to actually build it going forward.
Okay. And so today we are here to pretty much discuss what life insurance is and the importance of life insurance for those who may not know or not too familiar, as well as discuss the different ways to build generational wealth through life insurance. So tell us a little bit about that.
So life insurance there are two main terms of it. There's a term life insurance, and then there's a whole life insurance with permanent life. Term is normally 10, 20, 30 years, with the average being 20 to 30 years for a life insurance, meaning that when you do a term, let's say you're 20 years old and you do a term, it ends 20 years from now. So you'll be 40 when that life insurance policy is over, and then you're no longer covered under that insurance. Whole life covers you from the time you put it in place until the end of your, demise, I guess you'd say, for better lack of word at the moment. And then there's another life insurance policy or practice now. It's been around since 1997. It's called the Index Universal Life or IUL policy. And that is a life insurance, but is mainly a investment or savings, I should say, a savings vehicle for you that also acts as a life insurance policy as well.
Okay. And so, at what age is it advised to start investing in a life insurance policy?
As soon as you have a birth certificate, a date of birth, as soon as you're able to, get it, for a child, young kid, adult, the earlier, the better.
Okay. And what do you say to those who says, I'm afraid of being denied? Should I disclose all of my known health issues and medications on the application?
So there are life insurances for people who have health issues, and there are companies that specialize in that. It looks a little different, but there are policies out there, companies out there that specialize in people who have, issues there. But don't assume. Always talk to an insurance agent or sit down and talk with someone or do the research. Even with us, you can go to my website, you can reach us, and we can help you figure out what that looks like for you at your age and your condition.
Okay. So basically, don't count yourself out.
No.
Without, finding out first. Okay. And how does my health conditions affect life insurance premiums?
The healthier, the better. I mean, you pretty much have a standard. There's a preferred method. Most people fall in the standard, so it's based off of height, weight, age. But the healthier, the younger, the better your premiums will be. The more you're able to get for less. The older you get, the more you have to pay, the more you want.
Okay. Okay. And then what about those who says, like I have life insurance through my employer? Shouldn't that be enough coverage?
So the thing about that is, in the life insurance through the employer, I found that a lot of people, especially when I've done it, had it in the past, it really covered accidental deaths. It didn't cover just in general. It was more like if you accidentally passed, then it paid out. But typically, job life insurance is really only pay out maybe a salary and a half, 1.5%, 1.5 times what you make. So if you 40,000, it was gonna pay out an extra 60 grand to your family, and that would be the end of it. However, the other piece to that is it really falls under a group insurance, for the company. So when you either the company closes its doors, or you get laid off, or you quit, or you get fired, any separation from that job would terminate that insurance policy, for the most part, and then you wouldn't be covered. So if you're 20 and you started this job at the age of 20, and 15 years later the company shuts down, or you move, or you get laid off, you're no longer covered. But now you're 15 years older, and then when you try to get a policy, you'll be able to get one with no issues, but it would be a little bit more expensive because you're 15 years older, and you're closer to 100 than you were when you were at 20.
Okay. Okay. And kind of going back to the index universal life policies. So with those, if I understand correctly, they come with a death benefit and a living benefit. Can you talk a little bit about that?
So let's just say, in general, current insurances, both terms now, term and IULs, offer what we call living benefits, meaning that it pays out three different ways, whether you live, get sick, or pass. So what I mean by that is critical, chronic, and terminal illnesses. So if that happens, typically the policy will pay out up to 80% of the value of that policy. And what it means is, like, if you had a stroke or a heart attack, you couldn't work for 6, 7, 8 months, whatever that looked like, and then the policy would pay out a tax-free benefit to you while you're still alive, recovering, so you can pay your bills, up to 80% in general, of that policy. So if it's $100,000 policy, it would pay out 80,000, and you could use that money. You use that money to pay your bills and keep yourself afloat while you are recovering. The great thing about it is it is a tax-free payment. You don't pay any taxes on it, and so I think that's the great part about it. So you don't have to worry about filing that on your taxes or being hit with a big tax bill, because it's coming out of your insurance policy.
Okay.
With the IULs is probably my favorite, the index universal life policies. Those are a huge savings vehicle. It's literally investing in the number one thing you could is yourself. You are the number one. You investing in yourself. So for instance, there's an example on my website where it kind of plays a video where it talks about a young man. He's 35 years old. He puts $500 in there a month. And what you could put into an IUL can vary, but this is just an example. This doesn't go for everyone. But anyways, he puts $500 in there for a month, per month. And at the age of 65, when he gets ready to retire, if I'm not mistaken, it pays out $60,000 every year in retirement benefits. So he would get a check each month for the rest of his life, because he's paid into a retirement that that grew over time. And the thing that the IUL does that really puts it above the 401 and the Roth's IRAs is you don't pay any taxes in or out of it. Two, um, it does it grows its money by being attached to the S&P 500 or the stock. So as the stock S&P 500 does well, or whatever stock it's tied to does well, then you make money that year. And so as just like a 401, you make great money. But when the market decides, hey, it's tanking, and now all of the gains that you made that year, let's say you made 30,000 that year, but the market tanks because like you did in 2008 on people's 401, then you lose that 30,000 that you gained in years prior. Now you're back at square one, so to speak, and now you have to work longer and harder for that money to build and hope the market comes back. Well, with the IUL, it doesn't do that. If you gain that 30 gain, let's say you make 30,000 a year prior, but that following year, the market tanks, you don't lose that money. It's called zero is your hero, meaning that it'll kick you out when the market tanks, so you don't lose any money, and you keep all of your gains. So when the market returns, because it will, then you start making money again. So you have this constant incline of income building with your IUL versus a 401. So what I do is we can take people's old 401s that are currently sitting there not doing anything but losing money, and we can put that money and protect it. My company, we have and my affiliates, we have about $2 billion in assets that we have protect for clients. They're 401s, and we can put annuities together where you can put that money in a place where it can continue to grow but not have an impact to the market, a negative impact to the market. And you could, sleep better at night with that peace of mind.
Nice. Okay, so speaking of building wealth, so with the IUL, how long does it take to actually build the cash value with an IUL?
Well, that's kind of a tricky question to ask, but I could give a general level of understanding. Obviously, everybody's circumstances and setup will be different. But essentially, like this, you do an IUL policy. Let's say the goal is, 100,000 minimum for the death benefit or for the IUL. Let's say that IUL costs that person, depending on their age and everything, let's just say that costs you $120 a month. But you also say, well, I have a budget of $250. Okay, great. We take that $250 out of that $250. $120 goes to pay the premium for that $100,000. The other $130 that's being paid goes into the market to help grow your cash value. So what we do is we put it in the illustration, and it shows how it would grow its money. Typically, every so many years, 5, 10, 20 years, you'll see your money double, triple, and what have you. But it varies, and you would definitely have to sit down and talk with someone to see what that looks like. But essentially, any monies that you put over what the premium allowed or is asking for is how you build your cash value faster. I did one for a client where he says, hey, I want to put 200 in, but we did it for the lowest amount possible. At his age, it was 35,000. With the $200, it's going to build cash value, and I think at a certain age, it would have, make him about 60, 70K in cash value that he could pull out to do whatever he wants, whether it's buy a car, buy a house, pay for school, pay off anything, credit cards. You basically make yourself your own bank.
Okay. So when you build up the cash value, is there a minimum time frame that you could actually withdraw from the policy?
No, I mean you really want it to build. So you want to put this. You want to look at putting this money up so it can build. You don't want to typically keep pulling it out. You want to get it to a point where it starts making every year you can see the money just turning over because it's making great money, right? Mm-hmm. So essentially, if you're 20 years old and you start your IUL policy, you want to leave it there until it gets to a point where there's enough money to do what you need to do. The great thing about it is you can pay it back if you want. If you don't pay it back, then all it does is whatever you took out is less the death benefit payout at the end.
Okay, so it kind of comes out of the death benefit.
Well, no, the death benefit is already at the 100K as a deal, but let's say you build up 160 is 60,000 in cash in there, mm-hmm. and you take out the 60,000, mm-hmm. there's still the 100K there. Mm-hmm. Okay. So, but if you never take anything out and something happens, then it pays out to 160.
Okay, it's good to know. So, hearing all this good information, how do people decide, or like what's the best way for a client to know like which type of policy is best? Should they just kind of just like?
Well, that depends. I do it based off of needs and levels of understanding on what the client needs. So if a client says, "Hey, I want an IUL policy, but I also want something that's going to pay off the house for my wife and kids if something happens to me." So let's say, let's say that person is, 35 years old and the house is typically a 20, 30-year mortgage. So let's say we do a 30-year term at the price of the house. So the house is, and we have mortgage protection. They have different things, but let's just say we use a term. We could do a 20, 30-year term for $400,000. Okay, great. That's, let's say that cost that person at the time $150 a month. You put $150 in there a month. So if something happens, the term will take care of the house. But then you put some more change to the side into an IUL policy to build for your retirement. It's great for people who are business owners, who technically run their business, and all of the monies they get that come in is their business money, and they don't pay into a 401, they don't have a pension, they don't have any Roth IRA. You can use the IUL policy as a retirement vehicle for you. So let's say, you're a business owner and you put $500 in there a month, for the next 20, 30 years while you're working in your business, and you get to a point where, hey, I'm ready to retire from the business. You can sell your business at that time. You can hire somebody to continue running your business, but you wouldn't necessarily have to worry about your retirement because you would have that with the IUL policy.
Good information. So, any last remarks, or like how can someone get started? Like if they're ready to invest, like what's the first step?
Give me a call.
All right, and go ahead and give us your contact information.
Go to KMAC Financial Solutions.com, our website. On there, I have tons of information. All of our services are listed, from taxes, tax repair, credit repair, as well as life insurance information. And from there, you can shoot us an email. You can contact us. You can also check us out on Instagram and Facebook, just KMAC Financial Solutions. And we also have, this is going to be on YouTube as well, so you can go to our YouTube at KMAC Financial Solutions. I do believe we have a TikTok on KMAC Financial Solutions. My goal is simply to help people solidify their future and feel better at night when they know that they're going in a direction that they need to in a long-term financial setup. And for people to realize that it's not as expensive to invest in myself first, and take advantage of these products that can set us up. If you're a Lyft driver or Uber driver, which is really, you don't pay into a 401 with those. You don't have a retirement plan with those. This is something that people like that would definitely benefit greatly from. And there are tons of information. So just give us a call. And if I can't help you, I have a huge network of agents that we have access to that can work with you in your area if we need be. And we could connect everyone together and get you guys squared away.
Awesome, awesome, awesome. Well, that is all the questions that we have. So, if any other questions, be sure to reach out or contact us for more information.
Thank you kindly. Y'all have a blessed day.